Again, thank everyone for being subscribers to GAAFR Plus. I want to encourage everyone to be an active member in that community. So if you have any accounting or auditing or financial reporting questions or issues that you have, go ahead and post those in that community. Myself and the other GFOA staff, we look at that community. We'll answer any questions you have, or if there's other issues that you want to see how other members are dealing with a particular issue, post those in there and get some feedback from other members, and you can see how others are handling a particular issue that you might be having. So I encourage you to log in there and see post questions that you might have. It's a great way to interact with other members at GFOA. With that being said, as being a part of a GAAFR Plus subscriber, you get these four, each year we get 4 quarterly updates. So last week we actually posted a update on service organization control reports. So if we had a chance to download that from the library and read through that about all the controls that are involved with SOC reporting, that if you have a service organization, maybe you have a third-party administrator for healthcare processing claims, see what type of reporting you should be getting from those organizations. But today we're going to focus on a different issue for this webinar. A little house cleaning for today's webinar, though. If you have any questions as we go through the materials today, you can use the Q&A feature and submit that question in there. Michelle Mark Levine, our Director of Technical Services, will be in the background answering those questions through today's session. It would be helpful if you could either put the slide number or the implementation guide question number that we're dealing with in your question, just so we know what we're dealing with in case we fall behind in questions, just so we know what slide or question that you're dealing with in your question. Again, these slides could be downloaded from the learning management system. Probably logged in to get in today's webinar if you want to take some notes on today's session. Today's session is you're eligible for 1 CPE credit. In order to get the CPE credit, you're going to have to answer some polling questions. And these are going to be very simple questions. They're just going to pop up as I'm speaking. They're just going to be simple yes/no questions. They're not going to be based on the materials at all. All you got to do is click yes or no. Don't even have to read the question. Just click yes or no just to verify your attendance. Make sure you're participating in the webinar. The other part of this is make sure you stay logged into the webinar the entire 15 minutes that we're speaking on this. So don't log off and come back in. So we got to make sure you're staying in the webinar the whole time. After that, we'll go through and verify everyone stayed on and answered at least 3 of these pop-up questions. Those questions will stay on for about 90 seconds. So you have plenty of time to answer yes or no. I'll announce as they pop up that they're on. I'm going to keep speaking throughout the whole as they're on there. Just make sure you answer yes or no. After all the verifications are done later on, you'll get an email to go back into the learning management system, fill out a evaluation, then you'll be able to get your CPE certificate. So today's webinar is going to be based on the Implementation Guidance Update 2025. Now, this is hot off the presses. It was actually just released last month in June by GASB. It's a series of question and answers. This is a level B gap. Level A gap are the actual standards, all 104 that they have out there right now. That's level A. The implementation guide, these question and answers that come out by the GASB staff, where the GASB board just doesn't disagree with their issuance. They're level B gap. They're pretty high up on the authoritative guidance. So you have to make sure you're paying attention to these question and answers, because they're not the highest level, they're the second highest level of the authoritative guidance. Now, all these are effective for fiscal years beginning after June 15th, 2025, and all the fiscal reporting periods thereafter. There's a few exceptions. We'll see those as we go along. But just remember, everything's going to be effective June 15th, 2025 or thereafter. So in this implementation guide, there are 16 new question and answers. You can see there's a wide range of topics being covered in here. We have something on statement of cash flows. We have a lot of questions deal with the financial statements themselves. A lot of things on the new standard 103 that's sort of intertwined in all these different topics that we have. A couple of questions on leases. Actually, leases are actually built in some of the other topics that are listed on here. We actually have one on with debt from statement 91. We have 4 questions on statement number 100 on the counting changes and error corrections. Got one on statement number 101 for compensated absences. Then we have an amendment to some previously issued questions. Now, nothing significant here. There's no major wording changes being done. Not like that one where we had to go back and fix our capital assets. That one that came out a few years ago that caused a lot of angst for governments. So nothing major here on these 2 amendments. But we'll go through these 16 questions and briefly cover these 2 amendments that were issued in this implementation guide. So the first question we have is cash flow reporting. On question number 4.1, we see that not everything in the operating revenues and expense section of the statement of revenues, expenses, and changes in net position is going to be reported as cash flows from operations in our statement of cash flows for our proprietary funds. So in here we have the question is what additional information should be presented when a transaction is reported as an operating activity in our statement of revenues, expenses, and changes in net position, but then it's also in a category other than operating activities in the statement of cash flows. So if you remember in our our proprietary funds, you have to do the statement of cash flows. We have those 4 categories. We have operating activities, we have non-capital financing, capital financing, and investing. And we have specific definitions of what goes into our capital financing, non-capital financing, investing. And if it doesn't meet one of those definitions of those 3 categories, everything else goes into operating. So in our financial statements, we have something that we're going to report as operating revenue or expense. But then it's a category other than operating activity in the statement of cash flow. How are we going to report that and how we're going to handle this in our statement of cash flows? Well, what they tell us is we handle it as a reconciling item. So we have to do that because we use the statement in our statement of cash flows for governments. We have to use that direct method for the statement of cash flows. So we have to reconcile our operating income and loss from our statement of cash flows and our statement of revenues, expenses, changes in net position to our operating cash flows. So if you remember, on the bottom part of our cash flows, we have our reconciliation here. So we have our operating income or loss that we start with, and then we start with our adjustments. So like first thing usually we show is our depreciation. We add that back. So we just have this other item as a reconciling item being reported then. That's how we reconcile our operating income or loss to our operating statement of cash flows, our cash flows from operations. Now, before we get up, here's our first verification code. So please just enter yes or no for that. This will be up for about 90 seconds. Now, before we get into our next set of questions, a little refresher on GASB statement number 103 that's going to be effective. If you haven't early implemented, it's going to be effective for fiscal years ending June 30, 2026. So under GASB 103, we now have a definition of non-operating revenues and expenses. So non-operating revenues and expenses are these 5 items. If you have a contribution to a permanent and term endowment, any resources from disposal of capital assets or inventories, or gains or losses on disposals, those are considered a non-operating revenue expense. Investment income or expenses are going to be non-operating. Any revenues or expenses related to financing, so if you have like debt service payments, debt service interest, that's going to be considered non-operating. And then any subsidies received or provided. And I'll go through, we have definition of subsidies also under 103. We'll go through those in a moment as well. Now, the only exception here, unless that proprietary funds principal ongoing operations are one of those things. So if the proprietary fund is principal operations is investing, then all the investment income and expenses would be considered operating. Otherwise, everything here is considered to be non-operating. And then if anything doesn't meet the definition of non-operating, then that revenue expense is considered to be operating revenues or expenses. So they've defined what non-operating is. If it doesn't meet the definition of non-operating, it is a operating revenue or expense. So this goes into effect when your government implements statement number 103. Now, the other part of this, they defined what a subsidy is. It's one of these non-operating revenues or expenses. A subsidy received, so it's a resource received, can be from another fund or for another entity, another party as they define it. It's the resource received, it's resources that are coming in from the fund, and it's not based on what that fund, the goods or services that the fund provides. And if they did not receive those funds, they would have to increase the rates that are being charged. So for example, before I came to GFOA, I worked at community college, we would get an appropriation from the state of Illinois. If we did not get those monies from the state, we would have to increase our tuition rates. Now, we didn't provide any services to the state of Illinois, we just received those monies. But if we did not get those, we'd have to drastically increase our tuition rates. So that'd be a subsidy that the college was receiving. Now, resources provided, a subsidy provided, that would be that the proprietary fund is giving resources to another fund or another entity, and it's not related to any goods or services that are provided by that fund or the other entity. And they built those payments that are going out, those subsidies being paid, are being recovered through their rates. So they are increasing their rates to cover those payments that are going out. So that's resources that are being provided, it's a subsidy going out, and then all other transfers in, transfers out are considered to be subsidies then under GASB 103. So there's a little background on non-operating revenues and expenses, and we have our definition of subsidies under statement number 103. So with that backdrop, we have those definitions. Now let's look at these next few questions from the implementation guide. So if a proprietary fund has interest expense from borrowings that finance loans to first-time homeowners, is the interest an operating expense? So it's not listed here is that this operation, that this the first-time homeowners program, it's the principal operation of the fund. So remember that we said that financing is a non-operating expense. But since this is the program is the principal operation, should the interest expense for financing this program, should that be a operating expense? And the answer is no. So the interest expense related to financing are always non-operating. The interest income from this program, though, that would be considered. Now, there was a typo, and if you download the slides that were in the LMS, there's a little typo in there that the program, this homeowners program, first-time homeowners program, that's the principal operation. So the interest revenue that the fund is receiving, that would be operating revenue. But the financing to get this program going, the interest expense that the government is incurring, that would still be a non-operating expense. So the interest revenue, the program itself, operating, but the interest expense to finance the program is always going to be a non-operating item. Now, question 4.3 is an interesting question. This one and the next one, 4.4, these are not the two lease questions that were listed in when we talked about the summary of all the different question answers that came up. But these are related to leases, and very important if you're a lessor and how you're going to report lease revenue in your financial statements. So, if the principal ongoing operation of a business type activity or an enterprise fund is leasing property to others, Is the interest revenue on the lease operating income? So remember, if you read statement 87, make it very clear in there that leases are financing. And we know from statement 103, financings are non-operating unless the principal ongoing operation is, unless that's one of the principal ongoing operations of the fund. So you might think, well, the answer is going to be yes, right? Well, the answer here is no. The principal ongoing operation is conveying control of the right to use an underlying asset to others. It's not earning interest. So that interest income from this financing is non-operating. So the interest revenue can still be non-operating revenue. Now the question, if you download the question and answer from GAAFR's website, you can download all these implementation guides and all their standards and get the PDFs. You read further in there, it talks about, they still say leases are financings, but they're a different type of financing. They're not the same as like if you take out a bank loan. In leasing, you get revenue not only from the interest, but you also you get revenue from conveying that right to use the underlying asset. You get that remember when you enter, if you're a lessor, you get the receivable, and the other side of that is that deferred inflow of resources. You're going to amortize that deferred inflow. You get that revenue over the life of the term of the lease. So it's a different type of financing. So it's not the same as a bank financing. So only the interest in this situation, the interest revenue is going to be non-operating. Very important here. So if you're a lessor, remember the interest revenue, even with the principal ongoing operation, still going to be non-operating revenue. Now, following this guidance now, you have, should the revenue from that deferred inflow of resources from leasing property to others, that amortization at deferred inflow, is that going to be reported as operating revenue? The answer here is yes. Only the interest is going to be non-operating. The revenue from that deferred inflow does not meet any of those 5 categories we talked about of non-operating. So remember, for under statement number 103, if it doesn't meet the definition of non-operating, it goes into the category of operating revenue. So only the interest is going to be non-operating. The amortization at deferred inflow, that lease revenue that you're going to record, if you're a lessor, that is going to become operating revenue in your financial statements. So if you're a business type activity or a enterprise fund doing leasing, that the amortization at deferred inflow should go to operating revenue. Then we get into a couple questions on subsidies. So if you get a subsidy, how should it be classified if you use the subsidy for the acquisition of capital assets, but the provider of the subsidy didn't limit the use of how that subsidy was going to be used? So they didn't say it had to be used for acquiring capital assets. So you got the subsidy, you decided that you're going to use it for capital assets. There was no restriction, no limits on how it was going to be used. Well, in this situation, you would actually list it as a non-capital subsidy in your financial statements. Only if the provider put limits as to limited to the acquisition of capital assets, then in that situation, you report it as other non-operating revenue. But if there are no limits on how it's going to be used, you would report that subsidy as a non-capital subsidy. So looking at financial statements prepared under statement 103, if your operating revenues, your operating expenses, get your operating income or loss, then you have this section for non-capital subsidies, and you report it there. And then you'd have this new subtotal for operating income or loss and non-capital subsidies reported. This is the new format under statement number 103. Again, if there's no limits by the provider of the subsidy, but you just happen to purchase capital assets with it, you still report it as a non-capital subsidy. In statement, our second verification code is up. So make sure you answer yes or no to these. Remember, you got to answer at least 3 of these during our session today. Next question deals with payments in lieu of taxes, or pilots. So if you, in a situation, if you have a pilot made by a business type activity or a proprietary fund, does that meet the definition of a subsidy? Well, the answer is it depends. So you got to look at the substance of the transaction. If the pilot is as a payment for goods or services provided, then it's not. You don't classify it as a subsidy. If it's to compensate for lost tax revenue, and the fund that's paying the pilot, they adjust the rates that they charge, are set to produce enough revenue to cover that pilot that they're going to pay, then you would consider it a subsidy then. So short answer is it depends. So don't judge a book by the cover. Just because the fund is making a payment for a pilot, don't just assume it's going to be a subsidy. Look at what is the substance of that payment for. If it's for goods or services, not a subsidy. If it is to cover lost revenue, and that fund is going to make sure the rates are set up to cover that payment, then you would consider it a subsidy then. Another interesting question on subsidies. We have a little scenario where you have an insured person, they get coverage from they get healthcare coverage from a governmental entity. And then the insurer is responsible to pay the government provider. So the third-party insurer is going to pay the government healthcare provider. Now, remember, the third party did not receive the services, but the person did. So does that payment from the third-party insurer, does that meet the definition of the subsidy? The government provided the services to the insured individual. They have revenue, they're booking a receivable and revenue, but this third-party insurer is giving them the money. They didn't get the services from them. So it sounds like a subsidy, right? Well, the answer is no. The insurer is paying the government provider in place of the insured individual because they have this contractual relationship between the insured individual and the insurer. So they're just taking the place. So it's not a subsidy situation in this situation. The insurer is taking the insurance, third-party insurer is taking the place of the insured individual. So we don't have a subsidy situation in this situation. Just regular, the payment is taking the place of the individual. Our next two questions deal with everyone's favorite topic of leases. Seems like every guide's going to have questions on leases or SPIDAs or maybe some P3s involved here. So these aren't going to go away for a while. So we have a situation here. We have a government has a lease of a vehicle, and it ends after either 3 years or 60,000 miles, whichever comes first. So what is the lease term? So you may think, well, is it 3 years, or maybe it's not even a lease because you can't have a lease based on mileage, right? You can't have these variable components. I can't measure a lease based on mileage or the usage of a vehicle. Well, the answer here is that it's 3 years is the non-cancelable period. So that is the lease term. The 60,000 miles, that's an event that requires potentially early termination of the lease. So if that lease actually hits that 60,000 miles before that 3-year non-cancelable period, then they would have to reassess the lease and at that point and determine what remeasure the lease if that 60,000 miles is hit before the 3-year term. But the non-cancelable period is 3 years in this situation. Then we have a question on remeasurements for modifications. So if a lease liability is remeasured because of a modification, should the government remeasure at the commencement date or the modification date? So remember, modifications, these are amendments to leases. You could have a change in the lease term that wasn't part of the original contract. These are things that were things you got to think, like there weren't options in a lease. These were just complete changes to the lease. So we had a change in the lease term, we might be adding or taking away some of the underlying assets. There might be changes in the price that's being charged to the lease. So you have these are modifications being done to the lease. So what happens if you have a modification? Do you have to go back to the inception of the lease, or you actually do this remeasurement as of the date of the modification? So the answer here is this remeasurement due to a modification. You do the calculation as of the date of the modification. You might remember there was some earlier guidance about if you have a lease term and it's extended, you would reevaluate from the inception of the lease to determine if this lease was short term in nature, and it became you have to remeasure from the inception to determine if it's no longer short term. In that situation, you go back to the inception of the lease. In this situation, if you have a modification, you do the recalculation as of the modification date. Don't go back to the beginning of the lease, do it as of the modification date. .10 deals with conduit debt. So a little background on statement number 91 that was issued a number of years ago. Some of you may or may not be involved with conduit debt, but part of the rules of conduit debt, there's always three parties that have to be involved. You have the issuer of conduit debt, you're going to have a third party obligor, and you're going to have a debt holder or trustee. The other big rule part of conduit debt is that the third party obligor and the issuer cannot be part of the same financial reporting entity. So that means the primary government and the component units and their component units. So that's the financial reporting entity. So we have a question that a component unit issues debt on behalf of its primary government. So you have the component unit is being the issuer, and the primary government is the third party obligor. So they are within the same financial reporting entity. But the question is, for the purpose of the component unit's standalone financial statements, is this conduit debt? Now, if you look at if you did the primary government's financial statements that included the component unit, obviously this would not meet the definition of conduit debt, because that component units would be included in those financial statements, would not meet the definition. But when the component unit does its own statements, would that still be conduit debt? Or would it be conduit debt in that situation? Well, the answer here is no. You don't look at it from the financial statement standpoint. You look at it from the relationship between the issuer and the third party. So regardless of the standalone financial statements, we still have the situation that the component unit is the issuer and the primary government is a third party obligor. They are still within the same financial reporting entity. So in this situation, the component unit as the issuer in their standalone financial statements, they would report the debt as its long-term debt. This does not qualify as conduit debt in the standalone financial statements, nor would it qualify as conduit debt, like you said, in the primary governments and what includes the component in those financial statements. Doesn't matter if they're standalone or in the primary government statements, does not qualify as conduit debt. You look at the relationship, not as part of the standalone financial statements of the entities. Next few questions deal with GASB statement number 100 and our accounting changes and error corrections. Now, this question here is is there a change in a government's capitalization threshold, a change in accounting principle? Well, this one's starting to get a lot popular with governments. Some of you may have seen our recent paper on materiality, or you maybe read the June Government Finance Review article, and both of those discuss capitalization thresholds. Most of you might be aware of the uniform guidance update that went into effect last October, where it raised the threshold for equipment and supplies for capitalization from $5,000 to $10,000 in that guidance. So they're wondering, is that capitalization threshold change a change in accounting principle? And the answer here is no. A capitalization threshold, that's just applying materiality to an asset class. It's not an accounting principle. So if you change in a capitalization threshold, you don't restate beginning balances for that. That's what you do for an accounting principle. You have to restate beginning balances. Does not apply to this. This would be a prospective change. So if you increase your capitalization threshold for equipment from $5,000 to $10,000, that's as of whatever day you make that change. You don't go back. You don't have to go back and take off all the $5,000 equipment that you have. Those are still on there until you get rid of them. You start, here's our new $10,000 threshold. So you have $10,000 purchases. Those at that date, that's a prospective change. Everything above 10,000 or more, that's when you start capitalizing. But you don't have to go back and take off the items that are below $10,000 at that point. It's a prospective change. Next question, a little before we get into those, a little more background on statement number 100. Statement number 100, there is no more word prior period adjustments. So get that term out of your, if you go through your financial statements, do a word search, take that term out of there, get that out of your vocabulary. That term does not exist anymore. You either have restatements or adjustments. Or adjustments. You could have both in your financial statements. So restatements deal with any changes in accounting principle and error corrections that you might have. Adjustments apply to any changes to or within the financial reporting entity. So you make restatements and adjustments to your beginning net position, your beginning fund balance, or the beginning fund net position, like in the proprietary statements or the fiduciary statements. And you have to display those on the face of the financial statements. So at a minimum, you're going to have 3 lines on there. You're going to have your beginning position, either beginning net position, fund balance, or fund net position, as was stated in the previous year. A line for the restatement and or adjustments, and then what the restated or adjustment fund balance net position was. And then whatever the ending position is. So have to have those displayed on the face of the financial statements. We'll see an example of that in a little bit. But no more prior period adjustments. Don't put that term anywhere in your financial statements anymore. So this question 4.12, can an individual adjustment or restatement of beginning net position, fund balance, or fund net position be displayed separately from the aggregate, any other adjustments or restatements of those beginning balances? So you have multiple restatements and adjustments. Can you pick 1 or 2 and just highlight those on the face of the financial statements and aggregate all the other ones in one line? So like, can you cherry pick a few and then aggregate all the other ones on the face of the financial statements? The answer is no. Unless you're going to list out each and every, you're going to itemize each and every one, you cannot pick and choose individual ones and aggregate the other ones together. So it's kind of an all or nothing. Either itemize each one, or you have to aggregate them all. Can't just pick and choose a few and aggregate the others and just show the rest in the notes of the financial statements. Highlight them all, or collapse them all on the face of the financial statements. So here's what statement 103 looks like. This is from a governmental fund statement of revenues, expenditures, and changes in fund balance. So this would be the minimum disclosure that would be required. So you can see here, you have to show the fund balances from the previous year as previously reported. So no more fund balances as restated as a line. So you have to show, here's what was previously reported, and you have your balances as they were reported in the previous year for all the columns in the previous year. And then you have your adjustments and restatements. Assuming you have both, you could just have adjustments or you could just have restatements. show a line for those. If you're going to itemize them all, great. List them all out here on the face of the statement. And then you have your fund balances as adjusted or restated, depending what the issue is, and have that one line being reported here. So this would be the minimum. At a minimum, you're going to have 3 lines if you have an adjustment or restatement on your face of your financial statements. This would apply to the proprietary funds, statement of revenues, expenses, changes in that position, the fiduciary funds, changes in fiduciary net position, and in the government-wide statement of activities. Anytime there's going to be adjustment and or restatement, you're going to have 3 lines being shown here at a minimum. So make sure you're doing that. Don't say prior period adjustment. Don't just have 1 line, fund balance or net position as restated. Have to have the previously reported number shown here on the face of the financial statements. Then we have another question on changes in error corrections. This coin term we have GFOA has been using, those ghost columns. So we have funds that used to be major go into the non-major column. So how should a change in a fund's presentation from major to non-major be displayed in the financial statements? So yeah, the fund used to be major in the previous year, didn't qualify now this year to be major. Now it shows up on that non-major fund column. So you're going to have to show, probably better show the picture here. So you have to have a column to continue to be presented in the statement of revenues, expenses, or expenditures, and changes in fund balance or net position. We have to have that beginning fund balance or net position from the previous year reported, and then the adjustment to that balance, but no activity being reported. So you had this fund last year that was major. So we have XYZ fund. We put on here the parentheses, formerly major, because we want to highlight that it was major in the previous year. It's not major now in this current fiscal year. We're not showing any activity here because all its activity now is sitting in this non-major governmental funds column in this example. So all we're showing here, because we have to make sure that the fund balances from the previous year match last year. So last year had an ending fund balance of $5,000. So we have to have the beginning fund balance as previously reported, the $5,000. Here's our adjustment because it's a change within the financial reporting entity. We're reducing it by the $5,000. So the fund balance began of the year as adjusted is now 0. And it's being moved over here to non-major governmental funds. Here's our third verification poll. So make sure you answer yes or no to that. We'll be up for another 90 seconds. So again, no activity being reported here, no revenues or expenses or anything. We're just showing that fund balance being reclassified basically out of here. And in this situation is going to non-major governmental funds. So no activity, just moving fund balance out of here. In this situation, going to non-major governmental funds. So you got to show this ghost column here. Now, there's no guidance saying you have to have formerly major. We're just doing it to show why it's being reported like this, just to highlight that it's not a major fund this year, just to give the reader some guidance here as to why it's being done this way. But you do have to articulate last year's statements to this year's financial statements. And then what if you have a situation, if a fund, termination of a fund due to movement of continuing operation displayed in financial statements. So you have a major fund, doesn't exist because you moved the continuing operations out of the fund. So maybe you had a sanitation fund in the previous year, was an enterprise fund, it was a major fund. Then you move that sanitation operations to the general fund this year. What do you have to do for that? Well, same thing as we did in the previous question and answer. You gotta use that ghost column. You have to show major enterprise in the proprietary fund statements. You're gonna have a column for that. In my example, the sanitation fund, no activity, net position, previous year as presented, whatever the number was, adjustment, and then beginning net position of 0. Then you're going to have in the general fund, you'll see the adjustment, that number coming in there then. So you still have to use the ghost column approach for the movement of continuing operations for that. Then we have a question on compensated absences, but before we get to that, a little background on compensated absences. So the little paraphrasing of a couple paragraphs in statement number 101. So when you figure out, say, go through your compensated absences, you have, here's my number of hours of leave. You're supposed to take your number of hours of leave and multiply that by the employee's current pay rate, whatever they are making as of the date of the fiscal year end. So the liability for leave should be measured using employees' pay rate as of the date of the financial statements, so whatever your fiscal year end is, unless one of the criteria of the following paragraphs is met. One of those is if it is more likely than not, so it means the likelihood is greater than 50%, that some of the leave will be paid at a different rate. So you use that rate on that portion of that liability at the end of the period. So if you pay it at a different rate, use those hours times that different rate to measure the liability. Now, the other paragraphs are if it's going to be converted to a defined benefit post-employment benefit plan, then that would just be picked up by the actuary as part of the like the net pension, net OPEB liability. So it's not part of compensated absences, or if it's going to be part of a pool where people like donate hours or days to a pool where they all share the days, they have to use a representative rate. But the focus here is that what is this different rate? So the question that in 4.15 is a future pay rate, so you have some improved salary increase, a rate different from the employee's pay rate at the time the payment is made, that should be used in measuring the compensated absences liability. So you're doing your like June 30th financial statements, you have all these employees, you have this pay rate, they all got a pay raise on July 1st and they're all still employed, so you know they're already making more money. So when they leave, this compensated absence is already worth more. They're all still working, so they all got a pay raise. This compensated absence is worth a lot more money now. Or you have this collective bargaining agreement, clearly spells out what these pay raises are. So you should be using, it seems like you should be using these higher pay rates. Well, the answer here is no. The different rate referred to in statement 101 would be if you were to pay out a percentage of the pay rate in effect or a set dollar amount. So you use the pay rate as of the end of the fiscal year, so whatever they're making on June 30th in my example. If it's 50% of that pay rate is what the agreement is, you use 50% of that pay rate as the different rate. Or if it's we pay $20 for every 8 hours accumulated, that's a different rate. It's not, you do not factor in pay increases into the compensated absences liability. Those will be factored in the next year's calculation. So go to next, so June 30, 2026, you do that compensated absences liability. They're going to make on the July 1st of 2025, they got a pay increase. You're going to use that pay increase to measure the June 30, 2026 liability. Paragraph 20 of statement 101 clearly lays that out, spells that out, says that's when you would factor in that pay increase. So even if you know you have a collective bargaining agreement, spells out what pay increases are, you do not factor in pay increases into the compensated absences liability. You use whatever their rate of pay is as of the fiscal year end. They have the financial statements. That's what the pay rate should be. These different rates are the percent. If you have a percentage of the employee's pay rate as of that day, that's going to be used. That is considered a different rate. We have another verification code. So in case you missed one of these, there's another one to make up for that. So please answer yes or no to that. May have to get at least 3 done during our time here. So another question on statement number 103. So GAAFR 103 is effective for fiscal years ending June 30, 2026. That's if you did not early implement 103. So if you don't early implement, you still have your June 30th year end, your fiscal year that began July 1st, 2025. You're now in the GASB 103 reporting. So if your primary government is implementing under 103 under for June 30, 2026, and you have a component unit with a December 31st, 2025 fiscal year end, when should that component unit implement? So under the implementation rules for 103, June 30, 2026 are the first ones. If you're a calendar year fiscal year end, they wouldn't have to implement until December 31st, 2026. So the answer to this question is the component unit would have to implement on December 31st, 2025 financial statements also. So they would have to early implement statement number 103. Now, this was in the original standard. So when statement 103 is issued, it had, if the primary government early implemented 103, a component unit that was included would have to also early implement 103 because they have to have their statements on the same standards. So this is saying if the primary government is implementing on time, following the normal implementation calendar, if a component unit, they're going to have to early implement in this situation they have to follow 103 early. So if you're a primary government and you have a calendar year end component unit, please get in touch with them. They have to make sure they're implementing for their December 31st, 2025 financial statements to be incorporated into your financial statements for June 30, 2026. This one is effective now. This question and answer is effective when this implementation guide was issued. This is effective upon issuance. So make sure you're in contact with your component units if they are on a December 31st fiscal year end. Now, like I said, we had two questions that were modified from their original issuance. So we have question, this is 5.1. We have a title to an asset is equivalent to ownership. The answer hasn't changed. It may be evidence of legal ownership. All they did here was they modified the example being used in the question. It used to be an example of a lease, and they changed it to a example of a conduit debt associated arrangement. In those situations, the issuer of conduit debt holds a title at the beginning of that arrangement, but it doesn't actually recognize the capital asset. So they just changed that example in that question and answer. And then the other question deals with special revenue funds. So our government's required to use special revenue funds to report restricted or committed resources. The answer is still no, not required, except still if you have a general fund or a blended component, to report a general fund of a blended component unit. That's still the rule. And then they cleared up this, we broke out the second bullet here. If to report restricted resources that are legally mandated to include a fund that meets the requirements to report it as a special revenue fund. This was part of Statement 54 that was issued a long time ago, so it made be consistent with that standard. They just clarified that in this revised question and answer. Otherwise, there's nothing different, no big change here in this revision. So, so with that, the implementation of this Q&A, prospective implementation for questions 4.11 through 4.14. So you don't have to, no restatements for those, just implement those on a prospective basis. For all the other question and answers, we have to treat those as a change in accounting principle. So we have retroactive implementation. So a change in accounting principle means we have to restate beginning net position fund balance as applicable, assuming if they're going to be material or financial statements. So as you go through these question answers, if you may have to do some restatements as to implement a new accounting principle for these question answers. If you want to get more information on these, there's going to be some the August Government Finance Review will have a article on this implementation guide as well. So with that, I want to thank everyone for being a part of the webinar today. I'll stay on a little bit if anyone's got questions. Otherwise, thank you, and make sure if you've got questions about, if you don't want to answer, talk today, post them in the community, and we'll definitely post answers in there for everyone to see then.
Hey.
Otherwise, I want to thank everyone.
Yeah, I want to thank everybody too. We got some really good questions. Some of them I was able to answer, with some self-assurance, and some I had to say, well, I think this would probably be the answer, but I wanted to let everybody know that I've taken a copy of the questions down, and we'll look through them, and we'll try and get you some further clarification where I was not able to provide that today. And again, really appreciate some good questions and your attention. And thanks, Todd, for a great presentation.
All right. Thanks, everyone. Have a good day.
Recording stopped.